Hello and welcome to this webinar on consumer compliance, supervisory observations, and hot topics. I want to thank you all for joining us this afternoon or mid-morning, depending on where you're joining from. I'm Matthew Baloris, Director of NCUA's Office of Consumer Financial Protection. We ask staff from our team in OCFP to speak with you today on a broad range of consumer financial protection items. Before we jump right into the program, I want to offer you some technical tips to make sure you can see the webinar console and hear the presenters. First, all attendees will be in listen-only mode. If you have any questions, you can submit them at any time using the Q&A window, the question mark icon located at the bottom right corner of your WebEx console. If your sound is too low, please check to make sure your volume is turned all the way up on your computer. And if that doesn't work, you may need to plug in external speakers. Closed captioning will be available within the WebEx console. To access closed caption, please click the CC button located at the bottom left-hand corner of the WebEx console. And finally, the webinar will be recorded for on-demand viewing and will be posted on NCUA's YouTube channel. Next slide, please. A quick reminder, the materials presented in this webinar are intended as an informative and educational summary of general information related to consumer compliance focus areas and fair lending examinations. NCUA has taken reasonable measures to ensure the quality of the data and other information produced by the NCUA that is available in this presentation. The NCUA, however, makes no warranty, express or implied, and does not assume any legal liability or responsibility for the accuracy, correctness, or completeness of any information that is available through this presentation. The slides are intended for educational and discussion purposes and do not constitute legal advice. Next slide, please. To touch on our agenda this afternoon, I was thinking back, it's been about 8 months since many of us joined together with staff from our Office of Examination Insurance in January of this year to review NCUA's 2023 supervisory priorities. We've had time to review what our field examiners are finding, and we'll start the program by highlighting observations from our consumer compliance exam scope activities performed so far this year. We'll then move to a discussion on overdraft programs and some of the observations. We'll also provide a fair lending update and present you with some trends regarding what we're seeing with consumer complaints. And we'll close our discussion by highlighting some consumer compliance hot topics, including appraisal bias, automated valuation models, and reconsideration of value. And lastly, we'll leave time near the end to address questions you have posed before or throughout this event. Next slide, please. Before we begin the program, our team at OCFP is very pleased to introduce NCUA Chairman Todd Harper to make some opening remarks. Chairman Harper, the floor is yours.
Thank you so much, Matt, and good afternoon, everyone. Thank you for joining today's webinar. Earlier this year, I heard a podcast with former credit union examiners discussing the NCUA's 2023 supervisory priorities. They went one by one through the priorities listed in the January letter to credit unions, with each item generating strong opinions and discussion. However, when they arrived at the topic of consumer financial protection, the conversation ground to a halt. To recover from this awkward silence, the podcast host recounted a story from earlier in his career. He described the meeting as one in which his director of special actions at the time addressed the team about consumer financial protection, claiming that it was irrelevant to focus on compliance because the focus should be on whether the credit union was generating positive earnings. That message was disheartening to hear. And if you are participating in this call, you clearly understand that safety and soundness and compliance with consumer financial protection laws do not compete with one another. It is not a zero-sum game. Across the banking and credit union systems, the two, safety and soundness and consumer financial protection, go together as hand in glove. In fact, the NCUA's vision statement, unanimously approved by the NCUA board last year, is a clear confirmation of that relationship to, quote, strengthen communities and protect consumers by ensuring equitable financial inclusion through a robust, sound, safe, evolving credit union system. Many of you participating today are responsible for consumer compliance at your respective financial institutions, and your role is critical to the credit union system's statutory mission of meeting the credit and savings needs of consumers, especially those of modest means. Adhering to that mission is why I have long advocated for a stronger consumer financial protection examination program at the NCUA, especially for large and more complex credit unions. Such a program is in the best interest of the system, its members, and the Share Insurance Fund. It will ensure that as the industry grows and evolves, it remains true to its mission and its commitment to serve members of all backgrounds. And consumer compliance is not just a good principle, it is good business. Credit union leadership must also remember that we each do not live on an island. After all, the actions of one credit union with practices that harm consumers can affect the reputation and the earnings of the entire industry. Today, you will hear more about a variety of topics, including overdraft fees that can disproportionately fall on Black and Hispanic consumers, the NCUA's efforts to eliminate racial bias in residential home appraisals and automated valuations, and fair lending and consumer complaint trends. So thank you again for joining us. I hope that you will find this webinar informative and helpful. With that, I'll return the microphone to Matt.
Thank you, Chairman Harper, for those insightful comments and for helping to frame up our discussion nicely. So to kick off the discussion, I'd like to turn things over to OCFP Consumer Compliance Policy and Outreach Program Officer, Al Brantley, to highlight some of the consumer compliance observations from examinations performed by field staff. Al?
Thank you, Matt, for that introduction. Consumer financial protection is a vital element of member service. Violations are usually attributable to weaknesses in one or more elements or areas of the credit union's compliance management system, or CMS. Your CMS is important because it helps you manage risk with product and service offerings, as well as new laws and their implementing regulations. Examiners generally evaluate the effectiveness of a credit union's CMS during their regular examinations. Their overall conclusions impact the credit union's final compliance risk rating and CAMELS ratings for the management component and composite score. Consumer compliance expectations also extend to third-party relationships. If you outsource the operational aspects of a product or service, you remain responsible for complying with applicable laws and managing the risks associated with third-party relationships. This slide shows a side-by-side comparison of the targeted review activities for 2022 and 2023. NCUA examiners evaluated compliance with consumer financial protection areas listed for each year. Next slide, please. Based on a review of federal credit union examination reports completed in 2022 and a review of federal credit union examination reports completed so far in 2023, examiners cited several violations of the Equal Credit Opportunity Act and Regulation B. They made numerous recommendations related to credit unions' fair lending practices. These observations were separate and apart from the concerns identified and addressed in federal credit unions that received a fair lending exam or supervision contact. In this area, examiners found policies or guidelines that may be discriminatory or inadequate to ensure fair lending compliance. For example, loan policy was unclear about income sources and evaluation for debt-to-income calculation and when income verification was required. Lending guidelines contain provisions that explicitly treat applicants differently based on marital status when multiple applicants seek extension of credit. In some cases, disclosures did not inform applicants of their right to receive a copy of any written appraisal related to the application. In response to examiners' observations, the credit unions agreed to take one or more actions to address the issues. Depending on the facts and circumstances observed for a particular exam, management agreed to revise their policies and procedures, establish a formal appraisal review process, or ensure consumer disclosures reflect the proper content and timing of notification. As part of your overall CMS, you should ensure employees are educated on the applicable provisions of the Equal Credit Opportunity Act, the Fair Housing Act, and other federal consumer compliance laws. Next slide, please. Based on the review of examination reports completed in 2022 and thus far in 2023, examiners cited numerous violations of the Fair Credit Reporting Act and Regulation V. They made several recommendations related to credit unions' consumer reporting practices. In this area, examiners found many credit unions, those that furnished information about their members to one or more consumer reporting agencies for inclusion in a credit report, violated the Fair Credit Reporting Act and Regulation V by failing to establish and implement adequate policies and procedures. The law requires a furnisher to establish and implement reasonable written policies and procedures regarding the accuracy and integrity of member information provided to a consumer reporting agency. The policies and procedures must be appropriate to the nature, size, complexity, and scope of each furnisher's activities. If you are a furnisher, you must consider the guidelines in Appendix E to Regulation V in developing your policies and procedures. You must incorporate those guidelines that are appropriate. Further, you must review your policies and procedures periodically and update them as necessary to ensure their continued effectiveness. Next slide, please. This slide shows the most frequently cited consumer financial protection violations for all regionally supervised federal credit union examinations completed between January 1st and August 31st of 2023. Also represented are the most common provisions for each regulation that were violated. The high level of Fair Credit Reporting Act Regulation V violations correlates with the high number observed in our review of examination reports completed in 2022 and in the first 8 months of 2023. While most of the concerns last year related to Fair Credit Reporting Act policies and procedures, the violations reported this year mainly pertain to adverse action notice and risk-based pricing notice. For comparison, the total counts reported for the Fair Credit Reporting Act Regulation V, ECOA, or the Equal Credit Opportunity Act Regulation B, and the Truth in Savings Act violations already exceed the total counts reported for each respective law and regulation in 2022. Meanwhile, the total count reported for the Truth in Lending Act, or Regulation Z, violations is trending lower than in recent prior years. Thank you for your attention today. This concludes my portion of the presentation, and I will now yield the mic to Dina.
Good afternoon, and thank you, Al. I'm Dina O'Brien. We know that overdraft programs are important to you and your members, and that overdraft programs, how they work, and the related fees differ from credit union to credit union. Prudent credit unions maintain awareness of the complex and evolving market and regulatory requirements that govern overdraft programs. Next slide, please. The NCUA's supervision of credit unions includes reviewing overdraft policies and procedures to determine if a credit union is exposed to heightened reputation and consumer compliance risk or is vulnerable to potential litigation. Our review of this area dates back several years. In 2005, NCUA joined Federal Financial Institutions Examination Council, or FFIEC, members to provide interagency guidance about overdraft products by issuing Letter to Credit Unions 05 CU 03. The interagency guidance describes best practices for overdraft programs and recommends that financial institutions monitor applicable laws and regulations, including laws on unfair or deceptive acts or practices, to ensure that the overdraft programs are fully compliant. In 2009, the Federal Reserve published final rules that prohibited financial institutions from charging consumers fees for placing overdrafts on ATM or one-time debit transactions unless the consumer opted in or consented. Soon after, NCUA made comparable changes to its Truth in Savings regulation. The Dodd-Frank Wall Street Reform and Consumer Protection Act, also known as the Dodd-Frank Act, created the Consumer Financial Protection Bureau, or CFPB, in 2010. Among the other things, it made it unlawful for any provider of consumer financial products or services, or a service provider, to engage in any unfair, deceptive, or abusive acts or practice. In late 2016, NCUA again joined the other FFIEC agencies on an interagency call for the industry to address overdraft practices and issues identified through consumer complaints, examinations, and enforcement actions. Next slide, please. Overdraft programs, policies, procedures, controls, and disclosures may expose credit unions to potential reputational, consumer compliance, third-party, and exposure to litigation. Compliance risk may be heightened where disclosures and account agreements do not clearly explain or accurately reflect the credit union's overdraft practices. Reputation risk may increase when the credit union incurs fines and penalties or receives decreased member confidence because of its failure to comply with consumer compliance regulations. Credit unions that engage in any third-party relationships related to their overdraft programs should conduct ongoing due diligence and risk assessments in all 7 risk areas. There have been class action lawsuits against credit unions involving overdraft practices and disclosures. Some of these lawsuits have resulted in substantial settlements, including restitution and legal fees. Next slide, please. NCUA is aware of research indicating that overdraft fees hit low-income households and people of color the hardest. The Financial Health Network noted that low to moderate income households incurred overdraft fees nearly twice the rate of high-income households, and that Black and Hispanic households were charged overdraft fees at substantially higher rates than white households. During recent years, NCUA has received an increasing number of consumer complaints regarding overdraft payment programs. As you can see from the slide, we're on target to exceed last year's complaint volume for overdraft fees. Further, as noted on the prior slide, we are aware of several overdraft-related class action lawsuits against financial institutions, some alleging members were wrongfully assessed overdraft and/or NSF fees. Next slide, please. Fees have been a topic of concern among other FFIEC member agencies and have been discussed in interagency meetings concerning a broad range of consumer financial protection matters. Recent supervisory guidance issued by some other FFIEC member agencies, including the CFPB, FDIC, and OCC, highlight the potential impact to consumers of unanticipated overdraft fees. The guidance explains the unanticipated overdraft fees may arise in a variety of circumstances. For example, credit unions may charge overdraft fees that consumers would not reasonably anticipate when a debit card transaction incurs a fee, even though the account had sufficient available balance at the time the financial institution authorized the payment, sometimes referred as Authorized Positive Settle Negative, or APSN. Similarly, when a consumer deposits a check that bounces, credit unions sometimes have blanket policies to charge a return deposited item, or RDI fee, to the depositor. However, a person trying to deposit a check likely has no idea or control whether the check will clear. Further, credit unions may assess multiple NSF fees arising from the representment of the same unpaid transaction, potentially resulting in the member being unable to avoid fees related to represented transactions. Representment attempts can occur in close succession, and the member may be unable to correct the deficiency between the attempts. Next slide, please. FFIEC members also noted in their guidance the unanticipated overdraft fees may result in heightened risk of unfairness and/or deception under Dodd-Frank's UDAP provision, which prohibits unfair, deceptive, or abusive acts and practices, and under Section 5 of the FTC, which prohibits unfair or deceptive acts or practices. As shown in this slide, under UDAP, an act or practice is unfair when it causes or is likely to cause substantial injury to consumers, the injury is not reasonably avoidable by consumers, and the injury is not outweighed by countervailing benefits to the consumers or competition. An act or practice is deceptive under UDAP when the act or practice misleads or is likely to mislead the consumer. The consumer's interpretation is reasonable under the circumstances, and the misleading act or practice is material. Next slide, please. As part of our 2022 supervisory priorities, examiners requested information about the credit union's policies or procedures governing overdraft programs, auditing and monitoring practices for overdraft programs, and communications provided to consumers about such programs. We used the data collected to build a framework for a broader view of credit unions' overdraft programs in 2023. As a result, For our 2023 supervisory priorities, we are reviewing overdraft programs at credit unions with assets over $500 million to include a review of their website advertising, balance calculation methods, and settlement processes. We are also evaluating any adjustments credit unions have made to their overdraft programs to address consumer compliance risk and potential consumer harm from the unanticipated overdraft fees. Next slide, please. Based on a review of examination reports, examiners made the following supervisory observations. Some fees disclosed to members in the credit union's disclosure packet differed from amounts disclosed on their website. The credit union was missing disclosures when they advertised their overdraft services on their website. Total overdraft fees were not disclosed to the member on their statements. The credit union did not have a written policy as required by NCUA rules and regulations, and some credit unions had disclosures with vague language for certain overdraft practices. Next slide, please. As I stated earlier, our 2023 consumer compliance exam scope activities also include a review of adjustments credit unions made to address consumer compliance risk and potential member harm from unanticipated overdraft fees. Examiners have observed instances where the credit union's policies and procedures would allow them to charge one or more of these unanticipated fees. Examiners reach these conclusions by reviewing the credit union's overdraft program disclosures and holding discussions with the credit union management. We'll need to research such instances further to determine if the fees resulted in substantial harm to consumers, could not be reasonably avoided by consumers, and were not outweighed by countervailing benefits to the consumers or competition. If NCUA determines a credit union is committed an unfair practice, we have enforcement authority under both the FTC Act and the Consumer Financial Protection Act to pursue appropriate corrective action. In addition, we'd like to acknowledge that we observed instances where the credit unions have performed their own due diligence and these practices and determined not to assess fees under certain circumstances where it would be difficult for their members to anticipate and avoid the fee. We want credit unions to be mindful of heightened compliance, legal, and reputation risks of allowing these fees, and to consider implementing appropriate controls to mitigate the risk to the extent possible. Next slide, please. During our examinations, we heard you ask various questions about overdraft programs. The first is, NCUA telling credit unions that they should stop offering overdraft programs? The shorter answer is no. We know that overdraft programs are important to you and your members. There are several regulations which impact overdrafts, including NCUA's overdraft regulation in Part 701.21, UDAP, Our Truth in Savings, and Regulation E. In his May 2023 testimony before the U.S. House Committee on Financial Services, NCUA's Chairman Todd Harper stated that NCUA's supervision regarding this service aims to be a more equitable system that supports financial stability for credit union members, discourages over-reliance on fee income from one source, and improves transparency. Next slide, please. Another question examiners received this year was, our credit union offers overdraft program and it charges an associated fee. What policies and procedures should we have in place? Overdraft products and services and their associated policies, procedures, controls, and disclosures that expose credit unions to potential reputational, consumer compliance, third-party risk, and exposure to litigation are a concern for NCUA no matter the size of the credit union. In addition to ensuring that you have an overdraft policy that complies with NCUA's overdraft regulation, Section 701.21C3, you should carefully review and, if necessary, revise your overdraft policies and procedures, ensure staff and management are trained on overdraft-related laws and regulations, maintain awareness of regulatory actions and guidance regarding overdraft policies, and monitor member complaints. Next slide, please. A third question we heard was, our credit union charges a fee for return deposit items, authorized positive settle negative transactions, and multiple representment NSFs. What should we be doing? Overdraft fees assessed by credit unions on transactions that members would not reasonably anticipate are likely unfair. And the failure to disclose material information to members about representment and fee practices has the potential to mislead reasonable members, which is considered deceptive under UDAP. In his remarks to the Indiana Credit Union League in May 2023, NCUA Chairman Todd Harper noted how, as part of their mission and commitment, many credit unions are now considering how to restructure their overdraft programs to increase fairness or even drop overdraft fees entirely. These decisions will require adjustments to the revenue expectations, especially as overdraft fees make up a sizable portion of non-interest income at some credit unions, and as credit unions adapt to changing competitive marketplace where other financial institutions are already adjusting fees. Further, he stated, overdraft fee programs that allow for authorizing positive and settling negative, permit the charging of multiple representment fees, and incorporate multiple NSF fees are antithetical to the purpose of credit unions, detrimental to members, and inconsistent with the credit union system's statutory mission of meeting the credit and saving needs of consumers, especially those of modest means. We encourage credit unions to evaluate policies and member communications about overdraft programs, features, or terms and conditions to reduce the risks I outlined earlier. As a reminder, credit unions should note that revising disclosures may address the risk of deception, but may not fully address the risk of unfairness. Next slide, please. As I stated in the beginning of my presentation, we know that overdraft programs are important to you and your members, and that prudent credit unions maintain awareness of the complex and evolving market and regulatory requirements that govern overdraft programs. We want to make it clear that it is not our intent or role to have credit unions cease offering appropriate overdraft programs designed to help their members manage their cash flow needs. However, NCUA will continue to review the overdraft programs as they have significant consumer implications and expose credit unions to heightened reputation and consumer compliance risk and a vulnerability to potential litigation. While leveraging the cooperative and collaborative relationship with the other FFIEC member agencies to discuss overdrafts and supervisory observations, NCUA has been performing its own reviews to help inform our supervisory posture. Further, while NCUA cannot discuss any supervisory matters associated with a specific credit union, information gleaned from these reviews may be used to inform any supervisory guidance and/or policy recommendations for the NCUA board to consider. You are encouraged to closely review all aspects of your overdraft fee practices, review recent regulatory developments regarding overdraft programs and unanticipated fees, and take appropriate action to mitigate risks. Oversight of overdraft programs may include seeking legal counsel to determine if consumer compliance risk and responsibilities. Thank you for your attendance today. I will now hand the presentation off to Fair Lending Supervisory Examiner Matthew Nixon. Matt?
Thank you, Dina. And if we could move to slide 24, please. Good afternoon. As Dina said, I'm Matthew Nixon. Today, I'm going to discuss fair lending examination highlights. First, I want to bring to your attention an August 2023 NCUA Express message. The message references a 2022 letter to credit unions the NCUA issued. My team and regional examiners have identified a number of credit unions violating the Equal Credit Opportunity Act's, or ECOA's, anti-discrimination requirements in their use of automated underwriting systems. As a reminder, creditors are not permitted to discriminate against a loan applicant on a prohibited basis in any aspect of a credit transaction. The rule covers, for example, application procedures, criteria used to evaluate creditworthiness, administration of accounts, and treatment of delinquent or slow accounts, including age or marital status parameters in a credit union automated underwriting system that refers applications to a manual underwriting process based on or partially based on applicant age or marital status violates ECOA, and this is true regardless of the credit decision. If we could move to slide 25. I highlight a few fair lending examination priorities on this slide, but I offer the caveat that fair lending examinations are risk-focused. Examination focal points are selected based on an individual analysis of a credit union's risks, not based on a predetermined set of topics such as those listed on this slide. Approximately 20% of NCUA's 2023 fair lending examinations included redlining focal points, and we project roughly the same percentage in 2024. Credit unions with fields of membership defined by or partially defined by geographical boundaries should regularly evaluate their performance serving majority-minority census tracts within their service areas and adjust accordingly to any material underperformance. Because HMDA data assists the NCUA in identifying potential discriminatory lending patterns and aids our enforcement of anti-discrimination statutes, we expect credit unions to place proper emphasis on accurate data collection, recording, and reporting. NCUA uses the guidelines included in NCUA Letter to Credit Union 17 CU04, FFIEC Uniform HMDA Resubmission Guidelines in its HMDA validation exams. Credit unions should consider using the same or similar guidelines to evaluate their own HMDA programs. Over 40% of NCUA's 2023 fair lending examinations included HMDA data integrity focal points. ECOA protections apply to every aspect of a credit transaction, including the reliance on home appraisals before creditors approve a home mortgage loan. NCUA will continue to focus fair lending supervision priorities on matters related to home appraisal bias to ensure appraisals used to make lending decisions are objective and non-discriminatory. One last item before I turn it over to our next speaker. I want to bring your attention to Consumer Financial Protection Circular 2023-03 issued by the CFPB on September 19th. Per the circular, when using artificial intelligence or complex credit models to evaluate and deny credit to loan applicants, creditors may not rely on the checklist of reasons provided in the sample forms included in Regulation B to satisfy their obligations under ECOA if those reasons do not specifically and accurately indicate the principal reason or reasons for the adverse action. That concludes my portion of today's webinar. I will now turn it over to Sana Chris to discuss consumer complaint trends. Sana?
Yes, thank you so much, Matt. I am Sana Chris, the Consumer Affairs Program Officer, and I'm here today to share with you two basic categories of information. First, and for many of you, this will be a refresher, I'm going to talk about the consumer complaint resolution process. Next, I'm going to highlight trends in our consumer complaint data. Next slide, please. Before I delve into those topics, I want to provide you with some basic information about the multi-pronged approach that we have here at the Consumer Assistance Center. We are responsible for resolving consumer complaints against federal credit unions with total assets up to $10 billion, and in certain instances, federally insured state-chartered credit unions. We also have a very active and dynamic call center that we operate. Calls from consumers and credit unions concerning consumer financial protection regulations and our consumer complaint process. Finally, we also maintain a presence at mycreditunion.gov, and that is where we have a full set of questions and answers in our knowledge base area of that website, where we provide answers to common financial questions from the public and provide also an electronic portal for both consumers and credit unions to engage in the complaint process. Next slide, please. Now I'd like to tell you a little bit about our complaint process overview. But before I get into the specific steps, I want to highlight this important information. Before a consumer even files a complaint with us, we strongly encourage them to first reach out to the credit union in an attempt to resolve the issue. And the reason is pretty clear. Credit unions, as nonprofit financial cooperatives owned by their members, have an invested interest in meeting directly with their members to resolve complaints. And most issues are addressed prior to consumers even filing a complaint with us. But in some instances, that is not always the case. and consumers must go ahead and file a complaint with us. Once they do, in writing, file a complaint, that launches a 10 business day timeline for the Consumer Assistance Center to closely study and evaluate that complaint, and primarily to determine whether or not it is within our regulatory purview. That is to say, whether it involves a law or regulation that we can handle here at the Consumer Assistance Center. After that 10 business day timeline, the consumer's complaint, along with any associated documents submitted by the consumer, that is sent to the credit union. At that point, the credit union has 60 days to undergo a process that we deem here as phase 1, where they can attempt to resolve the consumer's complaint. During that 60-day process, we encourage credit unions to reach out to the consumer and try to address any lingering concerns that a consumer may have at that stage in the process. We will only move forward to the second phase of this if the credit union doesn't respond at all in response to receiving a complaint for us. Therefore, it's really important that credit unions who do receive complaints for us and choose to go through the attempted resolution process of phase 1, that they correspond with the Consumer Assistance Center and the consumer to inform us whether or not the complaint has been resolved. If we receive no correspondence from the credit union, we may go into a phase 2 full investigation. Other circumstances where we will move to a phase 2 full investigation involve a credit union telling us that they simply were not able to resolve the consumer's concern. And lastly, another and third instance is where the consumer receives correspondence from the credit union, but tells us they disagree. In their view, the complaint has not been successfully resolved. Next slide, please. So we talked about phase 1, attempted resolution, phase 2, our investigation. There is a bit of a third phase, and that involves the appeal process. In phase 2, the Consumer Assistance Center closes out its investigation by sending a determination letter to the credit union and to the consumer. Both the credit union and the consumer have the opportunity, if they disagree with the determination, to file an appeal, as long as they do so in writing within 30 days from the date of the determination letter. Next slide, please. And with that, I'll move to an overview of some of our complaint trends and highlight a few patterns for you. In 2022, we had a little over 10,500 written complaints that were submitted. We had 1,842 written inquiries and a whopping 30,232 telephone calls to our call center. Next slide, please. So you might be wondering about those complaints that we received. What are some of the top categories that consumers are raising in terms of the applicable regulation? Well, in 2022, the #1 regulation implicated was Regulation Z, which implements the Truth in Lending Act, closely followed in second and third place by the Fair Credit Reporting Act and Regulation E, which implements the Electronic Fund Transfer Act. Now, I'll stop here to say that these 3 laws are always the top 3 in our evaluation of our complaint data. The only thing that fluctuates is the rank among the 3, but these are perennially our top 3 regulations that we find in our complaint data. And the bottom 2 among the top 5 include NCUA's reg on TISA, the Truth in Savings Act, and Regulation B, which implements the Equal Credit Opportunity Act. Again, these 2 laws always make the top 5, and they vacillate in terms of the rank between the bottom 2. Next slide, please. And here I'm highlighting for you our top complaints by product type and issue for the year 2022. You'll see that our top products identified in consumer complaints include vehicle loans, customer service issues, credit card issues, consumer loan complaints, and checking account complaints. Now, before I move forward, I want to clarify that customer service is not an issue that falls within our regulatory purview. But we do find these complaints throughout our process where the consumer feels, if only my credit union had listened to me or spoken to me with respect and provided useful information, I would not have filed my complaint. So take note that customer service problems can linger throughout this complaint resolution process, and that can be avoided with the upfront process before a complaint is actually filed between the credit union and the consumer. Now, if we take a look at those products and examine what sort of issues or problems consumers are having, we'll find that the top 5 issues involve account closing, billing disputes, credit reporting, funds availability, and largely unauthorized transactions. It's interesting to note that when we look at the unauthorized transactions column, the largest product complained about has to do with consumers' checking accounts. And that makes sense as it correlates to increasing concerns with unauthorized transactions under Reg E. Well, that concludes my portion of the presentation. And now I'll turn it over to Rob Seuss.
Thank you, Stana. Appreciate that. I'll be giving you an overview of PAVE, AVM, and ROV. And of course, we like acronyms, right? PAVE stands for Property Appraisal Valuation Equity. AVM stands for Automated Valuation Model. And ROV stands for Reconsideration of Value. I'll also briefly cover the results of NCUA's efforts to collect information on credit unions' efforts to address appraisal bias in 2022. Next slide, please. In June 2021, President Biden announced an interagency initiative to combat bias in home appraisals. This interagency initiative became the Task Force on Property Appraisal and Valuation Equity. President Biden directed the PAVE task force to evaluate the causes, extent, and consequences of appraisal bias and establish recommendations to root out racial and ethnic bias in home valuations. On March 23, 2022, the task force released the action plan to advance property appraisal and valuation equity, which outlines the historical role of racism in the valuation of residential property, examines the various forms of bias that can appear in residential property valuation practices, and describes how government and industry stakeholders will advance equity through concrete actions and recommendations. Next slide, please. Here are the key themes of the PAVE action plan. Strengthening guardrails against unlawful discrimination in all stages of residential valuation, enhancing fair housing, fair lending, enforcement, and driving accountability in the industry, building a well-trained, accessible, and diverse appraiser workforce, empowering consumers, and enhancing data and research to study and monitor valuation bias. Next slide, please. Why is this important? Unfortunately, in 2023, we still have bias and discrimination affecting real property appraisals. Appraisal bias is a widespread issue. Researchers have observed a market value gap between majority Black and majority white neighborhoods for decades. A Brookings Institution report found that homes in neighborhoods defined as majority Black were on average undervalued by nearly $50,000, resulting in $156 billion in total lost value. When comparing similar homes in neighborhoods with the same socioeconomic status, homes in white neighborhoods were valued $371,000 more than their counterparts in communities of color. For example, around 2020, a Black couple in Marin City, California, received an appraisal on their home that they knew was too low. So they requested another appraisal. However, before the appraisal, they effectively erased themselves from their home by removing family photos, artwork, books, hair products, and anything else that might indicate that a Black family lived there. They also asked a white friend to display some of her family photos in their house and then greet the appraiser as if she were the homeowner to see if the appraised value would increase. It did. The second appraisal was almost $500,000 higher. The imbalance in appraisals increased throughout the pandemic, especially within the nation's hottest housing markets. Next slide, please. Appraisers assess homes in white communities as 2 times more valuable than homes in communities of color. Neighborhood racial inequality in appraised values increased 75% from 2013 to 2021. Homes in white neighborhoods appreciated 2 times faster than homes in communities of color during the pandemic. Racial inequity is growing 3 times faster in the hottest housing markets. Appraisers evaluate Indigenous, Pacific Islander, and Southeast Asian homes as the least valuable. Next slide, please. NCUA exam priorities for 2022 included a review of credit unions' efforts to address appraisal bias. The purpose of the review was to gather data on the number of federal credit unions with real estate lending programs that review the appraisals they obtain. And for those credit unions that did review appraisals, find out if they had identified appraisal bias concerns in those reviews. The questionnaire also helped engage in conversations with management about the importance of formal appraisal review process. 2023 exam priorities included a review of appraisal bias oversight procedures in federal credit unions that offer real estate loans and a tailored file review to evaluate the consistency, fairness, and accuracy of the appraisals a credit union obtains. Next slide, please. An analysis of the completed questionnaires from 2022 showed that more work needs to be done to increase credit unions' efforts to review for appraisal bias. Based on a sample of 303 federal credit union examinations, 136 unique credit unions reported having a formal reconsideration of value process, a formal appraisal review process, or both. Of these 136 institutions, 8 credit unions had only an ROV process, while 33 credit unions had only an appraisal review process. 95 credit unions had both an ROV process and an appraisal review process. None of the credit unions identified any instances of appraisal bias in the appraisals obtained. Examiners generally described the credit union's review processes and reiterated that no bias was observed. Next slide, please. Mortgage lenders and appraisers have been using computer models and algorithms as additional tools to improve valuation accuracy. AVMs have advantages over manual valuations because they save time, save effort and energy, save money, and reduce human error. Next slide, please. However, AVMs can pose fair lending risk to home buyers and homeowners because they are restricted by the accuracy of the data used for the calculations. They cannot factor in the condition of the property, and they are unreliable when valuing new properties. Regulators are especially concerned that without proper safeguards, flawed versions of these models could digitally redline certain neighborhoods and further embed and perpetuate historical lending, wealth, and home value disparities. Next slide, please. On June 1st, 2023, 6 federal regulatory agencies, including NCUA, requested public comment on a proposed rule designed to ensure the credibility and integrity of models used in real estate valuations. In particular, the proposed rule would implement quality control standards for AVMs used by mortgage originators and secondary market issuers in valuing real estate collateral. Under the proposed rule, the agencies would require institutions to adopt policies, practices, procedures, and control systems to ensure that AVMs adhere to quality control standards designed to ensure the credibility and integrity of valuations. The proposed standards were designed to reduce risk of AVMs by ensuring a high level of confidence in the estimates produced by AVMs, protecting against data manipulation, attempting to avoid conflicts of interest, requiring random sample testing and reviews, accounting for other possible factors that agencies determine to be appropriate, and promoting compliance with applicable non-discrimination laws. Next slide, please. June 8th, 2023, 5 regulatory agencies, including NCUA, issued proposed guidance for reconsideration of value for residential real estate valuations. An ROV is a request from a financial institution to the appraiser or other preparer of the valuation report to reassess the report based on potential deficiencies or other information that may affect the value consideration. The proposed guidance shows how ROVs intersect with appraisal independence requirements and compliance with applicable laws and regulations. They describe the risk of deficient residential real estate valuations and how financial institutions may incorporate ROV processes into established risk management functions. States that a financial institution's use of third parties in the valuation review process does not diminish its responsibility to comply with applicable laws and regulations, and states that financial institutions may consider developing risk-based ROV-related policies, procedures, control systems, and complaint processes that identify, address, and mitigate the risk of deficient valuations, including valuations that involve prohibited discrimination. The proposed guidance includes specific examples of policies, procedures, and control systems. Next slide, please. And we'll go to the next slide. Here's the contact information for OCFP. And now we have some time to answer some of your questions. So I'll send you back to Matt Boris for this part of our webinar. Thank you.
Thank you, Rob. Great information there. And now let's move into our Q&A portion of the webinar. As a reminder, if you have any questions for us, you can submit them using the Q&A window, the question mark icon located at the bottom right corner of your WebEx console. I'd like to introduce OCFP Deputy Director Lisa Robertson, who will be the voice you'll hear, and she'll walk us through the Q&A portion of the webinar. Lisa, do you have a first question teed up for us?
I do. Thank you, Matt. Before I get started with the questions, we've had a couple of questions about the availability of the slide deck. The registrants all received an email at 1:45 Eastern Standard Time from WebEx today. So if you didn't get that in your normal inbox, you may want to check your spam or your filter. Alternatively, the slide deck is available for download on the registration page of the webinar. You'll need to enter your information within the registration page in order to download the slide deck. Finally, we've had questions about whether it'll be on demand. And yes, you can view it on demand probably and by close of business today. So that's it for just some of the housekeeping things. We'll get started with the questions. Rob Seuss, the first question's for you. Does the NCUA anticipate including more compliance testing in the annual exams or increasing the compliance exams?
Well, the NCUA will continue to review compliance with applicable consumer financial protection laws and regulations for federal credit unions that the NCUA has under its Consumer Financial Protection Supervision Authority. Examiners consider trends in violations identified through examinations and member complaints, emerging issues, and any recent changes to regulatory requirements to establish priorities in reviewing consumer compliance each year. Thank you.
Thank you, Rob. Next up is a question for Matt Nixon. This question's about the fair lending slide that listed redlining, HMDA data integrity, and home appraisal bias as the examination priorities. Can you tell us, how does the NCUA evaluate risk and determine, for example, that my credit union will receive a redlining exam?
Thank you for the question, Lisa. So the NCUA reviews public HMDA and census data to evaluate redlining risks. And we review public HMDA data to identify credit unions with possible data integrity concerns. Given that this is public data, the data is available to credit unions to perform similar risk assessments of their institutions. We have not yet incorporated a data set or data sets in our fair lending examination program to identify credit unions with home appraisal bias risks, but we may in the future. If a credit union is pre-selected for a home appraisal bias review, it's likely based on information we received either from the district examiner or from consumer complaints. Back to you, Lisa.
Thank you, Matt. Next question is for Dina. Dina, I'm a compliance officer at a credit union. I keep hearing about UDAP. How can I learn more?
That's a great question. And as I said in my presentation, the Dodd-Frank Wall Street Reform and Consumer Protection Act, which prohibits unfair, deceptive, or abusive acts and practices, otherwise known as UDAP, that can cause significant financial injury to consumers, erode consumer confidence, and undermine the financial marketplace. For more information about UDAP or other consumer compliance laws and regulations, you can visit our Federal Consumer Financial Protection Guide, which is available on the ncua.gov website. The guide contains information to help you achieve statutory and regulatory compliance, including NCUA and interagency examination procedures. Your credit union's board of directors, management, compliance officers like yourself, and others have responsibility for compliance as part of your duties might find the guide really helpful. While it covers most of the federal consumer protection laws and regulations that affect credit unions, it does not address all the federal laws or state laws. So that hopefully will give you enough direction. And I appreciate your question, and back to you, Lisa.
Thank you, Dina. The next question is for Al. Al, we advertise our overdraft services on the credit union's website. What must our advertising message disclose to our members and potential members?
All right, thank you, Lisa, for that question. As outlined in NCUA's Truth in Savings Regulation, that's Part 707, any advertising or advertisement promoting the payment of overdrafts must disclose in a clear and conspicuous manner the fees for payment of each overdraft, the categories of transactions for which a fee for paying an overdraft may be imposed, the time period by which the member must repay or cover the overdraft, and the circumstances under which the credit union will not pay an overdraft. If the credit union advertises its overdraft programs on its website and does not include each of these provisions, the credit union has essentially violated NCUA's the NCUA rules and regulations, truth and savings regulation, which is that would be specifically section 707.11B1. However, I wanted to bring to your attention that there are some specific exceptions listed in the regulation. For example, the additional disclosures do not apply to overdrafts that are subject to the truth in lending regulation. That's regulation Z. If you have a response to a member-initiated inquiry through an automated system, such as a telephone automated call center, ATM, or website, or even an in-person discussion with your member. If there's information included on the periodic statement or notice informing the member about a particular overdraft item, that would be excluded. And also outdoor type media advertisements such as billboards and indoor signs would be excluded. We certainly encourage you to read and become familiar with the entire truth and savings regulation and the applicable sections, and then make any overdraft program adjustments as may be warranted. Thank you.
Thank you, Al. Next question's for Matt Nixon again. Matt, REMAs, or reasonably expected market areas, are being used by the banking regulators to justify expansive markets for potential redlining analysis. REMAs can include areas as large as multiple MSAs. How do NCUA examiners determine markets for potential redlining analysis? And do they use the REMA concept as applied by the banking regulators?
Thank you, Lisa. If we are considering a credit union for a possible redlining exam, we are primarily interested in credit unions with geographical based fields of membership. So that would be either a community charter or credit unions that have designated underserved areas within their fields of membership. And effectively, we consider those geographical boundaries to be a credit union's reasonably expected market area. We will compare performance within that geographical boundary to peer lenders who operate in the same area. Lisa, back to you.
Thank you, Matt. The next question is for Matt Beloris. So is the NCUA suggesting that if a credit union has an overdraft program, that even though they may disclose representment well, that a credit union should avoid a fee for representment of a check due to unfairness?
That's a great question. At the heart of that is a credit union capable of accurately disclosing it? And even if it is, there still might be an unfairness claim that a member can't anticipate when, let's say you've got a gym membership that's going to renew every month. You don't have the sufficient funds the first time. You don't necessarily know as a member when that is going to try to clear through again. The member may do it several times. They may wait. So unless there are augmenting controls that would empower a member with being able to control that, whether there's some sort of text alert system, there's something you've employed, it is a likelihood that that could lead to an unfairness claim. But again, we look at those things on a case-by-case basis, look at all the facts and circumstances. And I would suggest really a good line of defense for that is to listen to your members, talk to your member service reps. Are you getting a lot of complaints about this? There could be some education you could do, but also it may lead you to the conclusion that maybe the first fee is something that they should obviously expect. Maybe ones after that may lead to that unfairness claim. So give some thoughts to that. Lisa, back to you.
Thank you, Matt. The next question is for Rob Seuss. Letter to Credit Unions 11-05 explains that NCUA operations are not funded through what happens if the NCUA, if the government shut down on September 30th? Sorry.
Well, letter to credit unions 11-05 explains that NCUA operations are not funded through congressional budget appropriations. Therefore, NCUA will continue to operate business as usual in the event of a shutdown. Individual deposits at credit unions will also remain protected up to $250,000 before, during, and after any shutdown. Thanks.
Thanks, Rob. Next up is a question for Rob as well. You mentioned that the 2023 NCUA exam priorities included a review of appraisal bias oversight procedures in federal credit unions that offer real estate loans. What are examiners specifically reviewing?
Well, examiners are completing a three-part fair lending questionnaire this year that includes a review and assessment of appraisal bias policies and practices related to residential real estate appraisals, including monitoring, auditing practices, managing third-party relationships, and appraisal complaint response. In addition, examiners review a sample of three real estate loans, and they want to evaluate consistency, fairness, and accuracy of the appraisals a credit union obtains. That's it. Thanks.
Lisa, I think we got time for maybe one more.
Okay, we've had a question about a guide that was referenced earlier. I think you're referring to what Dina presented. So I'm going to throw this over to you, Dina, if you could handle it.
Yeah, I think you're probably right, Lisa. So the Federal Consumer Protection Guide that we have is available on ncua.gov, and that guide will help credit unions achieve that statutory and regulatory compliance that we're all looking for, and also includes the NCUA and interagency examination procedures. So that I think would assist all of our credit unions, and I think that you're absolutely right, Lisa. That's what they're looking for.
Thank you, Dina. I appreciate that. It looks like we're at the end of our time this afternoon. I want to thank you all for joining us and helping to make this such an informed discussion. I also want to thank Chairman Harper for joining us this afternoon. And I want to thank our OCFP team of Lisa Robertson, Ernestine Ward, Matt Nixon, Dina O'Brien, Al Brantley, Sana Chris, and Rob Seuss for a great job. I really appreciate all the work you do for consumers, team. I think it's important to provide transparency in our process by telling credit unions what we'll be reviewing each year, and then hosting follow-on events like this to present some observations from these reviews. So thank you. As I indicated at the start, this webinar will be available on NCUA's YouTube channel in the near future. This does conclude our event, and I wish you all the best for the rest of the week. Thank you for joining us.